morning, dear investors. We welcome you all for the annual outlook presented by Khandwala Securities Limited. This is a very important period of market where we are looking at the annual how the CY24 will be and what is our equity market outlook, debt outlook, and on gold, what is our outlook that we are going to see. Without further ado, I would like to invite my colleague Rishikesh to start the presentation with the agenda and henceforth. Thank you.
I welcome all the participants for this webinar, and thanks for taking out time on this Saturday morning. So to begin with, we have seen this that for calendar year 2023, the performance of Nifty has been really good. So to say specifically for Nifty, which is around 20-22%, with mid cap and small cap doing better than that. So if we really compare it with the global markets, yes, the Nasdaq has done really well. But the other like S&P also has done equally well, 23%. Is a very good return that S&P also has delivered. So that would like to share that thoughts also with all of you. So just to make sure this outperformance of Nifty has been with a lot of geopolitical tensions. There have been a lot of policy rate decisions which have gone against in terms of, they have really gone up last year specifically. Now they have started to cool off a little bit. But yes, that has been a bad times in terms of policy rates going up. Commodity prices were highly volatile. So that again has kind of, made things difficult for equity, so to say. But nonetheless, with the domestic economy being more resilient, and the capex cycle also kind of picking up, infrastructure development and spending also picking up, and we have seen the record GST collections. So all put together with all bad things which happened in terms of tensions and related things, we have still managed a decent growth in terms of Nifty in earnings as well as in terms of what the capital market has delivered for CY23. So this next slide, this one is about the earnings growth. So the earnings growth, yes, have been good, especially in last 2 to 3 years, where the earnings per share, if you can see here, have gone up from around 450 rupees in FY20 to as high as around 800 rupees last year, that is FY23. So the expectations of earnings also is equally good in this year, that is FY24. And of course the next financial year as well. So the earnings per share compounding is expected around 18 to 19% for this 4-5 years, which is good in terms of what earnings Nifty will deliver for earnings. So this is about the Nifty trading. So we see that the Nifty currently is at around 19.5, 20 times the P multiple, which is roughly 6% premium to the long-term average of 18.5. So if we really see the Nifty, which more consists of the large cap stocks and mega cap stocks, the valuation still seems to be in much more reasonable sense. Here, this is about the large cap valuations, which again are at fair zone. So this is nothing but a temperature gauge of how things are fared. So this will consist of price to earnings, price to book, market cap to GDP, earnings yield, all put together where the valuations of Nifty look like, as in for the large cap, how it looks like. So which is more or less in the fair zone as of now, even if the movement that we have seen in last 6 months to 1 year, they are not still climbing the wall of worry, and much better in terms of fair valuations that they have. So this is a very interesting slide. Okay, now here what we are trying to mention here is that the kind of earnings expectations that we have and the kind of valuations that we have right now. So we are right now in that fair to kind of little expensive zone. But in such cases, when such things happen, the compounding for next or the 3-year return CAGR is more or less in an average of 8%. So we are not expecting something phenomenal returns, let's say this year or maybe next year. So the expectation of the returns would be more of a moderate in a sense. So it's around this is what the past data has suggested, that it could be in a range of 8% or so. So this is what we expect going ahead as well. So this is again is a very interesting slide. So what we are trying to say here is in terms of what is a premium for valuations if we really compare with the Nifty and Nifty mid cap and Nifty small cap. So here we would like to mention that the long-term average for Nifty mid cap is around 23.5, 24 times P multiple. And currently we are in a range of 28 times, which is more or less 18 to 20% premium to the average long-term valuation. And similarly for small cap, with the phenomenal rally that we have seen, especially in last 6 months, the long-term, the premium for this Nifty premium is really gone up. So it is now as 35%. So normally the Nifty small cap P is around a range of 15.5, 16 times. Now it is around 22 times. So that is sharp up move, which we have seen. And that is a little cause of worry, so to say. In this slide, what we have mentioned is what kind of movement. This is a Nifty small cap index for all of you. Now, what we've seen is in 2018, we had seen a sharp rally in small cap index. And that's where, the small cap index had gone from around 5,000 levels to as high as around 9,000 levels. And with that kind of movement which happened, we saw further cool off after in a couple of years later. Similarly, in 2021, also we saw that phenomenal rally in small cap index around from 5,500 to as high as 11,000 on small cap index. And then we again saw that, for 1 year, 1.5 years, there was a cool off in terms of a small cap index. Just like that, we have seen for last 1 year, there has been a phenomenal rally again from around 10,000 levels to now as high as 15,000, 16,000 levels. So which again is a sharp rally. And that's the reason why we expect that after this rally, maybe there'll be a cool off. Of course, not expecting near as now maybe, but over next, let's say 1 year, things might cool off quite significantly from the current levels. So this slide will again tell about long term from 2006 onwards to now till 2023. So we have seen that in terms of returns, which the market has delivered. So let's say, for example, a small cap has delivered 80%. Then we have seen that there is a negative return the next year. Similarly, in 2009, 100%, and again minus 30 later on. So similarly, in 2018, around 55% returns that Nifty small cap has delivered. Later, it has delivered like minus 30%. Similarly, now we see around 50%, 55% return in 23 for small cap. So we can expect not so good returns, or I would say negative returns in 2024, especially in the later half of the year for the small cap, and also for overall market cap, it could be laggard kind of returns. Yeah, so this is about talking about the valuations. Now we are coming to this PEG ratio. So this is especially for the developed and all the emerging markets put together. So what we see is the valuations for long term and especially for large cap companies. Now here we see that around 22 times is a P for India, and EPS growth is also significantly higher, around 17%. So now the PEG ratio for overall Indian markets is around 1.3 times, which is really good in a way that it's not that expensive. There are certain markets like UK, Australia and others which are as high as 4 times on PEG ratio. So we are fair in terms of valuation, still not that expensive. This is a market cap to GDP where we see that around 124 times is the market cap to GDP for Indian markets. The long-term average is around 80%, and we are above that mark. So that this year it is little cause of concern, but on a lot of parameters, especially in the large cap valuations, look little better in terms of to compare it with the other indices. So this is about the Indian markets and how contributor we have been in terms of global growth. So for 21-22, we have delivered outstanding 16% growth. 23-22, we have again delivered good growth. 24-23 CY, again we are expecting really good growth. So around 17%. So we see that, with respect to a lot of good things that have been in the economy, be it like in a capex cycle, be it the real good and well-capitalized banking system, strong upturn that we have seen in the real estate, and of course the services sector, which has really contributed to the export part also. We see that there's a lot of contribution from that, and hence our economy has developed, has really delivered good growth. Yeah, so I'll welcome my colleague Sameer, and he will take it up. Thanks.
Thank you, Rishesh. So, broadly, as Rishesh was pointing out, the second half of this year will be quite challenging for equity markets in India, and especially for large cap. We feel the valuations are in a fair to little expensive zone, but the small cap and mid cap is the indices where we see there's a euphoria. So that is a view for the market for CY24. But if you look at the broader picture, we feel that this decade belongs to India, and that is mainly because of the few factors that I will list out in the following slides. So India's GDP is likely to surpass $7.5 trillion by 2031. Even manufacturing share of GDP is likely to grow to 21% in next decade. At the same time, the per capita income will grow from $2,200 to around $5,000 plus in 2031. This will help to boost the consumption in Indian economy. At the same time, export market share is likely to double to almost $1.2 trillion in the next decade. Credit to GDP growth, the credit to GDP ratio will also improve from 57% to 100%, implying a compounded annual growth in credit of 17%. So in all, we feel that because of these factors, market cap is likely to grow at 11% over the next decade. So though in the short term, we are slightly bearish on the market, the valuations are on the high side, we feel that this decade belongs to India. And as we will see in the further slides, this is a buy on dips market. That's what we feel. If you look at the kind of domestic money that is flowing into Indian markets, that is very huge. So if you look at FPI holding, foreign portfolio investor holding, that is a decadal low, but our domestic investors are making a new high in terms of investment they are doing on an annual basis. SIPs have gone up to 18,000 crore per month, which is a record number. At the same time, if you look at the household savings, that is into equities is only 5%. So there is a long way to go in terms of equity contribution to the total savings of households. So we feel that though FPIs are selling in equity markets in India, domestic mutual funds and domestic institutions and retail participation will help to counter this sell-off. At the same time, the most important part in the global scenario is the inflation cooling off. So CY23 saw a record inflation in global markets. But over the last 3 months, as the commodities have cooled off, we have seen a drastic reduction in inflation numbers globally. And this is resulting into US Federal Reserve tapering the rate, and they have already announced 75 basis point rate cut in the next calendar year. So this augurs well for equity valuations going ahead. And we feel that as the inflation is cooling off and bond yields in the US, 10-year GSEC has already fallen from 5.1 to around 4. This is likely to go to 3.3 to 3.5 in the CY24. This will augur well for equity valuations in the long run. At the same time, we just want to highlight our view on gold, because in falling interest rate scenario, gold does very well. This is a chart which is showing history from 1991 till now. So here you can see in 1991 to 1994, when the interest rate came down, that time gold delivered 170%. In the second cycle of 2001 to 2003, when rate sharply came down from 6 to almost 1, that time gold delivered 272% return. And recently in 2018-19, we have seen around 153% return in gold when the interest rate came down. So interest rates coming down globally in the US market is really helping gold to go up. So this time we are expecting this rate of 5%. US Federal Reserve is likely to get it down to around 2.5% over the next 2 years, and that will benefit gold. And at the same time, if you look at cycles from 1970 till now, the first gold cycle was from 1970 to 1980. That time gold has gone up from $30 to almost $700. At the same time, from 2000 to 2014, we have seen a massive rally from $200, $1,200. So these kind of rallies are followed by, this time also we are expecting falling interest rates in US will also help gold to give a very good cycle this time also. So at the same time, we are seeing central banks are accumulating gold in a big way. That is also helping gold to go up. So overall, our view remains quite very positive on gold for CY24 and CY25. To conclude on our view for CY24, we feel that CY23 Nifty mid-cap and small caps have delivered a stellar return of around 50% plus compared to Nifty, which is mere 20%. These returns are in small and mid-cap are front-ended, and we feel that investors should be cautious in mid and small cap space of the market. The stage starting point may weigh on the equity returns for CY24, and especially in second half of CY24, equities are trading at a peak valuation, and the sentiments in the market are also at a peak. So whenever you get these kind of peak sentiments and valuations, there is a euphoric moment in the equity markets, and we feel that post-election verdict, there will be a negative return period for equities. Historically, during the election years, equities have delivered good returns. We believe that post the state elections, as we have seen in December till now, the Nifty has already rallied 12%, and market is already factoring in Prime Minister Modi returning to the power. Any negative surprise in the election outcome will result in a correction in second half of this year. Also, market is factoring in 300 plus kind of number for BJP, but any lower number in the central election results will result in a correction in equity markets. A likely third term for Modi is likely to see continuation of policy making in investment-led growth, and infrastructure and manufacturing will continue to do well. If you look at global markets, US recession, the market is now in the US is factoring in a soft landing, and we feel that US equity rally depicts rising confidence of this soft landing. The falling US Federal Reserve rates will support the gold prices, and we feel that gold will continue to do well over the next 2 to 3 years. Some of the sectors we are positive on are manufacturing, because if you look at the production linked incentive scheme that the government has come up with for almost 60 plus sectors, is resulting into a manufacturing boom in India. Government is highly committed to this production linked incentive schemes for electronic sector, for defense, railways. So some of these sectors will continue to benefit from this manufacturing push by the government. At the same time, the banking sector credit growth will continue to hover at 12 to 13%, and banking being 35% of index will continue to perform well. That's what we feel. At the same time, if you look at the realty sales numbers by some of the large players in the equity market, some of the large players in real estate, they are doing exceptionally well. On month-on-month basis, they are making new sales highs, and even the real estate story is very, very positive in terms of sales growth plus prices picking up in the realty market. Automobile on the premium side is doing equally well. At the same time, as Rishesh in the earlier slides pointed out, that earning growth will be quite strong for the next 2 to 3 years. We are not worried on the earning front in equity market. Domestic flows continue to remain very strong, and the relative attractiveness which Rishesh highlighted on price to earning to growth ratio, we are relatively attractive compared to other emerging markets. In all, we feel that CY24 long-term investors should treat Nifty levels of 23,500 to 24,000 as a profit booking opportunity, and any dip towards 20,500 to 20,000 Nifty level as a buying opportunity. So this is our broader view on equity markets. So if you look at the risk and concerns which are there in market right now, valuations are definitely at a higher level in small and mid cap, and definitely we feel that investors should actually do the profit booking in this space, and even they can think about systematic withdrawal from small and mid caps over the next 3 to 6 month period. At the same time, worsening geopolitical situation in Gaza, Iran and Red Sea is resulting in a spike in crude oil prices. So this continues to be a cause of worry. At the same time, unforeseen large credit events globally because of this higher rate of interest may result in a correction in equity market. Lastly, if this soft landing what we have talked about, if it doesn't come true, then US economy will see a hard landing, and equity markets in the US also may correct. General elections, everybody knows that this is a big election everybody is looking forward to, and any negative surprise will result in a correction in equity markets. So with this, I hand over to my colleague Sonal for the technical view of KSL. Thank you.
Thanks. A very warm welcome to all investors, and thanks seniors for giving me this opportunity. So I'll start with the US indices, the mother of all markets. So the S&P 500 index, the earlier view was that it would sustain closer to 4200. Then if it crosses 4450, then 4600 will be tested. But the index at this current juncture has been surpassing expectations, and it is almost at a risk distance from the lifetime highs. So earlier last month, we saw it getting nervous to the same level, to 4800, and from there we saw some dip coming into the market. But earlier this week, we could see the index again rebounding immediately. So there still seems some steam still remaining into the markets, and if and only if we see the lifetime highs being taken out, then we are in for one more leg of the rally, wherein it will be difficult for the bears to pause the markets from here on. It is good that it is spending some time closer to the earlier highs. Earlier, when it had taken resistance closer to these levels, the reaction was sharp, the downside was sharp. This time, the attempts seem much more reasonable, and the probability is not that bad. The highs may be removed. So let's wait for a confirmation. Already we are in good gains at this point in time, and till 4580, 4600 roughly, those levels are intact. We could still expect the index to contribute on the higher side. So for risk averse investors, like a buy and dips opportunity will definitely be much more feasible from the risk reward scenario, and let's hope for the better. Coming to the Nifty index, Nifty, we saw very good rally. The earlier highs got respected. Levels mentioned were 18,600 to 18,800 ka range. 18,800 higher levels got respected. Then we saw good rally building up from there on. Slowly and steadily, the market, the Nifty index, removed 19,300 resistance, 19,800 resistance, and then it has achieved all the targets previously mentioned. 21,500, the earlier market targets which were mentioned, and it has surpassed those expectations also. So hardly any complaints from the index. It has over-delivered, and we still do not see any major downside from here on. So what we have to approach is that we should not chase markets at higher level. Look for good risk-reward scenarios. There will be jerks within this uptrend, and the outlook should be to target sector-specific and strong momentum stocks. That has helped in the short term, and this should be the way going forward. Overall, the targets on the higher side, based on projections, are closer to the 23,800, roughly 24,000 mark on the index. So, which is not that far away, but tips can definitely be looked at. So overall, there is some fatigue, but that fatigue has, if we go into the recent past, that fatigue has been short-lived. So once we see a good dip, definitely the investors which have a left-out feeling will be more keen to get into the markets. So coming to the Bank Nifty index, Bank Nifty has under-delivered, and this has been the case for quite some time now. So earlier also we saw it not delivering to the kind of expectation we had from the index. Given the beta, it should have been at a much better level than what it is trading at the current juncture. But still, hopes will still remain, since it's trading above the resistance levels. That is, it's trading in a very low resistance zone kind of a scenario. So although it has under-delivered, but then the hope will still remain. We are targeting nothing less than 50,000 on this index, and if we give some time, play with levels, definitely we could see this index also delivering after testing some more patience. So Bank Nifty, a slight positive bias on the higher side. Coming to the gold index, as my colleague Samir pointed out, that rosy picture can be pointed out this particular commodity is concerned. But even on the charts, what we are seeing is that this commodity has spent a good amount of time, say for almost 4 years. It is trading between a range between say 1700 on the lower side and 2100 on the high side. So it's been quite some time, and this time the attempts are pretty much repeatedly. It's what it is doing at this point in time. It's making the resistance weak. Whenever we see a breach above these resistances, then we could definitely see a much more strong rally building up. So for that, what it has to do is that it should close minimum above 2070, as you can rightly see into the chart highlighted, and 2100 on the higher side will act as a confirmation. Till then, before it breaks and surpasses the resistances, till then we can use dips to get long into this particular commodity. This view on the technicals will remain intact till 1970 is in those levels are intact on this particular index. So gold, rosy outlook, we should wait for the confirmation or else buy on dips. That's it my end. I'll hand over to Nirupam, who will be taking after the mutual fund side. Thank you.
A warm good morning and a very happy new year to all our esteemed guests. I'll be taking you all through the mutual fund section and spend around 5 to 7 minutes. For the January 2024 edition, we would like to introduce to a new concept which we believe is going to be a need in the portfolio going forward. After the new tax rule which has come in effect in debt fund, which says returns from any category of debt funds investment made after 1st April 2023 would be taxed. And as per the slab rate, you will be taxed and debt funds, which makes debt funds less attractive. And also given the fact we are into a high level of the market, so balanced advantage fund as a category could be looked at. I'm sure most of us you must heard about this category called balanced advantage fund. Let us understand what is balanced advantage fund and the tax liability. The investment made into balanced advantage fund get invested into two asset class, that is equity and debt, and are managed more dynamically with certain predefined parameters, which makes it very attractive. Because of asset allocation among equity and debt, it does not take into account any personal opinion and views on market of the person managing the fund. Importantly, the equity balancing is happened on a daily basis. Since it is a holding is 35% always in equity, it enjoys an equity taxation. Let us look at the illustration and see how it is more benefited through dynamically managed portfolio. Refer the row highlighted in green. In the year 2013, the equity allocation went as high as 77%. In that year, we had a taper tantrum in the US. Back then, the US 10-year treasury yield had jumped from 1.6% to almost 3%. Please refer the row on your right side highlighted in red. Back in 2018, when valuation of the market went very high, the equity allocation came to almost close to 30%. Similarly, during the COVID times, the equity went to high of almost 74%. In all these 13 years, the average equity level were almost close to 50%, which has resulted into a return of 12% compounded return over 13 years. In fact, it has outperformed the Sensex return over this 13 years. A very good category to consider from a medium to long-term perspective. Given the market at this level, we strongly suggest our investor to consider large cap category and a flexi cap category for investing with a time frame of 3 to 5 years. And typically, large cap fund will have mostly invested into a large cap companies, and in flexi cap category, the large cap universe ranges from 75% up to, or I would say it's up to 75%, and person managing the fund has an option to add little mid and small cap companies, which makes it less volatile compared to the pure small cap fund. Also, the category to avoid is certainly a small cap schemes. We believe, and as shared by my colleague in the earlier slide, the valuations are slightly stretched, and we start and we recommend our investors to start moving out from now until next 6 months by way of systemic withdrawal plan. On the fixed income side, given the current high inflationary environment across the world, the interest rates have picked up globally and in India as well. Generally, the interest rate cycle are one-time cycle of topping and bottoming in 3 to 5 years. Unlike the equity, which gives you a entry and exit cycle always. Having said, we strongly recommend consider fixed income at this point of time. In fixed income, we suggest considering fixed deposits of company like Bajaj Finance, which is offering 8.6% for 42 months, and for senior citizen, it's 8.85 for 42 months, which is very attractive. This brings to our end of our presentation. Hope it was a good insight and you all enjoyed listening to us. Now we will open for question and answer session. I would request our audience to raise their hand and ask question or put your question in the chat box. Thank you.
We have already received a few questions in the chat box. So I would just like to invite Ajay sir to share his view on equity markets, what we have discussed earlier, but he can share his wisdom with us. Over to Ajay sir.
In line with what Samir had mentioned earlier, looking at the past 1 year returns, generally there's a lot of euphoria in the market and everyone wants to be in equity right now. But it's important to have the right expectation setting. And after a strong market last year, I think we should be very happy if we are able to move from this around 21,500 to 24,000 level in the first half of the year. And I think second half of the year will be maybe a range bound market where we'll trade in the range of maybe 22,000 to 24,000. So broadly, we should expect a return of not more than 8 to 10% in the coming year. So from 21,500 to 24 is broadly that 8 to 10. So we should set ourselves for lower expectations after a very strong year last year. And we should take some money off from small cap mid caps after such a stellar rally of 50%. And we have shown you that over the last 20 years, whenever we have had such strong rallies, the next 2 years have been years of negative to muted returns. So the broad call is take money off from small cap mid caps and allocate that money to large caps. That's the broad call.
Thank you, Ajay. The next question is on IT sector. I would like my colleague Rishikesh to throw some light on his view on IT sector.
Yeah, thanks. So IT, yes, there has been some movement last week. So of course, the results of TCS and Infosys were expected not so good, but they have delivered little good results. And of course, the commentary for these companies were really good. So that's the reason why IT has done well. But considering the valuations that we are in right now, they're a little on the higher side now, getting little on the higher side, not exactly there. But yes, the kind of up movement that we see now in IT would not be that much, especially in the large cap segment. There could be certain stocks which are really focused on a niche segment where the growth will keep continue to happen and they'll keep continue to surprise. The valuations there are still high, but they'll continue to be high, and that's where I think the focus should be on because that's where things will be better for IT as such. Thanks.
But broadly, I think we can expect around 10 to 12% returns for the IT sector. Valuations there are not very crazy.
Thank you, Rishish and Ajay sir. The next question is very interesting. So the participant is asking, how can we manage the potential downside risk in our investment strategy as the market is trading at all-time high? So the potential downside risk is coming from the risk we have highlighted in the presentation, which is geopolitical risk. At the same time, worsening geopolitical risk, what we have seen in Gaza, Iran and Red Sea. And at the same time, the elevated valuations are the major cause of worry. And lastly, the election outcome we have to look forward to. And how we should protect this downside. That's why we are recommending to book some profits at current level so that your profits are protected. And at the same time, at the higher level, so you can consider a systematic withdrawal from a smaller mid-cap space over the next 3 to 6 month period. That can be one strategy to protect your downside. And at the same time, move the money from the smaller mid-caps to large caps, which are less volatile. And whenever there is a drawdown, the large caps correct lesser than mid and small caps. So that can be one strategy. Another strategy can be move some money from equities to debt instruments, as my colleague Nirupam has spoken about. So that can be another way to protect your capital. in these volatile times. I would like to ask Ajay sir to also share his view on this point.
So basically, and also my view is that besides that shift from small cap, mid cap, and from equity to debt, also you will have to be an opportunity investor this year. I think the market, unlike last year, will not be a one-sided rally, and you will have very good trading opportunities. So a buy and hold approach might not work as well this year. You will have to be nimble-footed and use those trading rallies. That's my broad view.
On gold, investors are asking about how do you invest in gold. So we suggest we can definitely consider gold ETF, which are traded on exchange, as a route for investing. But at the same time, some of the mutual funds which are having gold exposure, and they also have an exposure to gold mining companies. So these mutual funds can also be considered for gold investments. Nirupam, can you please highlight your view on whether to buy gold bonds and what is the outlook there?
I think buying the gold ETFs or this mutual fund which invest in companies which mine gold and in gold ETFs is a better option, because gold bonds is very difficult to sell. So you can buy, but selling is very difficult in the secondary market if you believe that the rally is over and now you want to exit. So we believe the ETF route is a better route.
Thank you. The next question on Nasdaq, as Sunil has given his view on S&P 500, the investor is asking his view on Nasdaq.
So Nasdaq has been leading as far as if you compare what S&P has done. So Nasdaq has hit the fresh lifetime high, which S&P hasn't, and it is still trading above those levels, still looking attractive, still taking its own chances. And what we require is after a very good rally, there has to be some kind of a consolidation or some sideways consolidation so that it could get ready for the next move. So the charts are still healthy. If at all there is some correction, it will be taken with a good stride. It will be a healthy one. Buyers will definitely be more tempted to get on dips. And it is one of the better indices within the US indices. So we should be approaching it from buy and dips approach. Thanks.
The next question is on mutual funds, whether investors should invest in a lump sum manner or through SIP route. So I would like to have Nirupam's view on this point.
So we certainly believe that SIP and systemic transfer plan from liquid to equity would be ideally a good to start at. And given the fact, as you know, some of the slides has been presented by my colleague, that we feel that post-election, like around post-April, May, we might see some consolidation in the market. That could be a good time to do a lump sum investment. But to begin now, we should consider putting into a SIP route or a systemic transfer plan route and front load the investments post election results.
Thank you, Nirupam. The next question is about NBFCs. So the investor is asking, Ajay sir, what is your view on NBFCs and private sector banks?
On private sector banks, our view is that larger private sector banks have underperformed the index over the last 2 years. Even last year, where the index returns were over 20%, the larger private sector banks were only at 10 to 12%. So I think we can expect them to have a broadly decent year of around maybe 12% returns. HDFC Bank has not moved at all over the last 3 years. ICICI Bank, while it had moved earlier, this year has been broadly only in the larger banks. SBI also hardly moved. Some smaller PSU banks have moved. And I think the larger NBFCs should do okay because they have had good growth. So even this year, if you see the largest two NBFCs, Bajaj Finance has grown at 35%, Chola Finance has grown at 35%. And it looks like they will maintain growth maybe at 25-30%. Right now, the RBI is very worried that unsecured lending in that 0 to 50,000 category has gone up very sharply. So they are trying to put measures to curb lending, and that's why they have increased risk weightages. But I think probably the good NBFCs should have a decent year of maybe around 12 to 15% returns after underperforming the market this year. Thank you.
Thank you, Ajay sir. The next question is about the interesting instrument, which is Bitcoin and the crypto market. So we feel that the valuations, so how to value this Bitcoin is a very, very tricky point. and we feel that investors can take a very small bet in Bitcoin, but overall we don't recommend investors to have a very high allocation in Bitcoin kind of instruments, because to value these currencies is very difficult, and the volatility in that instrument is very high. So that's why we recommend either avoid or have a very, very minimal allocation there. The next question is about sectoral funds. So some of the AMCs are coming up with sectoral funds like manufacturing, defense. So can Nirupam and Ajay sir share their view on some of these specific sectoral mutual funds that are coming up, manufacturing, defense kind of mutual funds?
Certainly, I think this sectoral funds, especially the funds which are based on the capital goods or defense and PSU, there's still some steam left. And as you we have also highlighted in the slide that if this government continues, then the investments and the focus of this government would remain into the capital goods and infrastructure. So this story could work out well. But only thing is that we would suggest our clients don't get into this thing with a very high return expectation. Something like 12 to 15% return should be ideally one should expect and get into this. And that too also we suggest to invest over next say 5 to 6 months.
Also, I think that the fund managers are already doing a good job of ensuring that sectors where the growth outlook is better, they have larger weightages there. So I think we should not have more than 10 to 15% of our portfolio in sectoral funds. We should let the fund managers do their job.
Investor is also asking about some of the sectors which we are negative on or where we have bearish view. So basically some of the sectors we are negative on, basically not sector but on broader index. Mid cap and small cap is the indices where we see a major pain in the second half of this year. And that's why rather than a sectoral call, we have a view on indices. So mid cap and small cap are the indices where investors should be cautious, and they should be treating, as we have already discussed, systematic withdrawal from some of these asset classes over next 6-month period. At the same time, some of the sectors where the valuations have gone off the roof are defense, but the story is a long way to go. So we feel that defense, India wants import dependence to be brought down very drastically, and that's why defense as a sector will have a high earning growth for next 3 to 5 year period. But only thing is, investors should treat this sector as a very long term investment opportunity, and at current level the valuations are on a very high side. The next question is about public sector banks. So public sector banks, our view remains that the largest public sector bank like SBI, we are positive on, because the valuations there are quite reasonable, and at the same time the credit growth of around 12 to 13% will definitely benefit this public sector bank. And lastly, if you look at the YONO app which SBI has come up with, that has really helped it to move ahead in terms of digital footprint in this banking sector. So we feel that the large cap PSU bank like SBI can be looked at in the PSU banking sector. The next question is quite interesting. So investor is asking Ajay sir his view on some of the investors he's following, and some of the global investors or domestic investors he's really admiring. So can he share his view on that?
So in India, we admire Shankar Narayan of ICICI a lot because he is able to take contrarian calls at the right time. And for example, in 2018, when small cap, mid caps were at PG valuations, he advised to get out of them. In 2019-20, when value stocks had done very badly for 3 years, he gave a good call on buying value, because value as a theme had done quite badly, while growth had done very well for almost 6 to 7 years. And interestingly, we tend to admire Howard Mark, and I think reading his notes to investors can give you very good insights. That's what I want to add. And I think that even in HDFC, Navneet Munot has done an outstanding job. These are some guys that we track.
The next question is to Rishikesh. We have seen a very strong rally in PSU stocks like Coal India, Power Grid, NTPC. So can he share his view on some of these PSU stocks and the valuations he is looking at that sector.
Yeah, thanks. So the PSU stocks have seen a lot of run up, that's for sure. But even with that run up, the valuations are more towards mean now. A little expensive, not that much. But obviously, when such rallies happen, they don't be on the mean or little on the expensive side. They go more on the expensive side, and that is yet to happen. That is one thing. Secondly, in terms of growth, yes, the themes there have changed completely from, let's say, earlier they were not a part of ESG portfolio. So somewhere, when the something which is non-ESG was not considered good, but that's the thing which has completely changed, and hence people and the investors are getting into such stories. So they will continue to do well, and obviously there is a lot of steam still left, and the valuations are not that crazy where things are really out of control. So on the dips, even on these levels, if there is any chance that investors should buy these stocks, because there is a lot of things which is still pending to be delivered. Thanks.
And we especially feel that some PSUs in the power sector like NTPC Power Grid still offer some value. But maybe closer to elections and after elections might be a time when some of them would have run up too much, and it would be time to take money from PSU stocks. But going forward, the return expectations from PSU stocks should be more muted, and maybe they'll be more like index returns after a lot of them have gone up multifold over the last 2 years. So I don't think they will outperform the index significantly now going forward after such a huge rally. And it might be a good time to take some money off from PSUs around election results. That's the time when they might be closer to peak.
Thank you, Ajay sir. The next question is about National Stock Exchange. So when the IPO is likely to come, and our view on NSE. So I would like to have Ajay sir's view on NSE, National Stock Exchange. Though it's unlisted, he can share his view.
The NSE has grown at around 30% for the last few years because of the large numbers of investors who have been entering the stock market in India, and it has almost 93-94% share of trading in the markets. It's like a monopoly, and globally such monopolies get a multiple of 35 to 40 times. The NSE is trading at a multiple of only 25 times, so it seems like a good investment. The listing might take another 12 to 18 months because now the investigations into the earlier MD and that team is almost over. So maybe we have another 18 months of wait before we get listing there.
Thank you. The next question is on railway sector. So what is your view on railway sector and companies like IRCTC and Titagarh, etc.? So our view remains very constructive on the railway sector, but we are mainly looking at some of the companies which are supplying parts to these railways. So if you look at the Vande Bharat train which government has launched, that has resulted into a sharp uptick in order book for some of the companies in capital goods space. So rather than companies like IRCTC and Titagarh, we also like companies which are supplying parts to this newer generation railways. And at the same time, the ecosystem around railways is also evolving. And that's why some of the companies in the T&D space, even in the electronic signaling space, electronic braking space, some of the global suppliers are very active in that segment. So we like companies like some of the companies like ABB, Siemens, CG Power, which are supplying parts to these railways. And we feel that compared to IRCTC, it is better to participate through some of these companies rather than participating through IRCTC. The next question is about some of the large, one of the large auto company announcing their buyback. So we feel that if you look at the buyback ratio, only 1.4% of your shares will be bought back by the company, and that's why investors will not be benefiting in a big way in this buyback. Though the buyback price is 10,000 and current price is around 7,500, we feel that as the acceptance ratio will be only 1.4%, we are not seeing a very huge return opportunity there. That's our view on one of the buyback. On the renewable and energy sector, as Ajay sir pointed out, we are positive on the power sector in the long run. But in the short term, if you look at their 12-month, 18-month performance, the prices have gone up really high. The valuations are on a stretch level. But the only point is, we feel that if you look at the capex that is happening in the power sector, these companies should be considered as a buy on dips opportunity rather than buying at such a elevated level. And at the same time, the peak power deficit is now happening across India, and we are seeing power cuts coming in metros also. So rather than tier 3, tier 4 cities which were seeing these power cuts, we are seeing power cuts coming in Mumbai, Pune, some of the metro cities also. So peak power deficit is there right now, and we feel that some of the power companies should be bought back on dips. On renewables, we feel that some of the companies in wind energy can be looked at on dips, but overall our view remains that power sector, on the traditional power sector guys, we are more bullish than the renewable sector companies. The next question is about the risk which we have discussed earlier. So the risk, I will just once again highlight some of the risks what we have discussed. So geopolitical risk, and at the same time elevated valuations, hard landing versus soft landing, what is expected in the market. These are some of the major risks apart from the much talked about general election outcome. So some of these are the major risks in the equity markets right now. One more question is on pharma. So I would like my colleague Rishikesh to answer this question on pharma sector. What is your?
Yeah. So on pharma, yes, obviously there are different types of companies. One is catering to US generic market. One is for Indian markets. So US generic markets, they have really started to come up. So especially after the pricing pressure which was there in US markets for quite some time, that has started to ease out, and that is where a lot of pharma companies based out of especially related to US businesses have started doing well. So we can see that good momentum will still continue with these pharma companies. Apart from that, companies which are focused to, let's say, the Indian markets, they are also started to do well, and they'll continue to do well as well because of the growth coming back, and obviously the valuations are still reasonable. Here they have really gone through that pain over last 2, 3 years, 4 years, and the rally which we had seen earlier in 2015, the crazy valuation, they are still not there. So we believe that with the growth momentum which will continue, and a lot of issues related to maybe the generic market segment, they are behind us. But there'll be certain points related to US FDA thing which will keep coming. So there'll be some buying opportunities on the dips which we can get. And I think investors should look at good companies with strong promoter entity and strong background. Continuously focusing on growth, should invest on the dips as well as the current levels as well.
The last question is on the chemical sector. The investor is asking, because of this China Plus strategy, how do you see chemical sector benefiting? So we feel that the chemical sector is seeing a pain over the last 12-month period because of heightened pricing competition from China, and we feel that it will continue to remain in muted growth zone over the next 3 to 6 month period. But some of the companies are available at attractive valuations there. So you can come back to KSL team and we will discuss more in detail about some of the stocks in this space. And we remain constructive about this China Plus strategy which is there. And once again, we feel that you can definitely come up, you can contact some of the advisors in the KSL on on the individual stock ideas, and we will be more than happy to answer the questions in more detail. So some of the stock specific questions we have not taken, but I would urge investors to come back to your respective RM, and we can definitely answer the questions in more detail. So that concludes our presentation for today. I really thank all the participants, all the investors for taking time out on Saturday morning